All right, guys, so let's talk about our deal structure here at BCGK. So first of all, every deal we do is a little bit different. There's sort of a basis for how we structure our deals, but each deal is a little bit different, situational as far as the exact structure. So you'll want to make sure every time we release a deal to look into the summary documents to see how one varies from another. But I'm going to go ahead and explain to you sort of our typical deal of how we structure things. So first of all, there's the equity split or the upside split. And so what we do normally is we'll take 30% of the upside for being the sponsor, the general partners, and we'll give 70% to the investors or the limited partners. So what that means in layman's terms is if the property ultimately is purchased for $3 million and sold later for $5 million, and let's assume that's all profit, that $2 million, we would take $600,000, and the $1.4 million would go to the investors. So that's our normal split. In addition to that, when you're an investor, you'll also be in line to get some 90-day mailbox money, the checks, or maybe in this case with the portal now, the ACHs. So as Kevin explained in one of the videos, make sure to check it out, the distribution video, our typical pref is somewhere around 4 or 5%. I've got here 4 to 6%. It's going to vary deal by deal, but basically that means if you put $100,000 into a deal, you can expect that you're going to get somewhere between $4,000 and $6,000 paid back to you throughout the year. And that will, of course, be broken out quarter by quarter. The other thing that we're shooting for on a deal is a target equity of 2 to 3x. So that same deal, if you put $100,000 in, you can expect that when we ultimately sell the property, that our goal is to hand you back $200,000 to $300,000. Now, deals are different, projections are projections. We go into deals with the best intentions. Of course, that's not to say that one deal, the final return might be this, the other one it might be that, but we feel very confident with the fact that we do significant underwriting, inspections, due diligence to be able to offer this type of return. I would also refer you back to the PPM and the video that was done on that. Check out all those documents deal by deal because that'll have the business plan, that'll have the projections, and sort of everything that we're trying to do on each particular property. So minimum investment. This is a great question. We actually get asked this a lot. We don't really have a minimum investment, but if I had to put a range on it, which I did here, I would say it's $50,000 to $100,000. Again, that's sort of situational. We've had investors invest $15,000, $10,000 with us before, and we've had investors obviously choose to come for much bigger amounts. I will say that sometimes if it's a big raise, so if we're gonna buy a property that's $8 or $9 million, or $15 million, or $20 million, and we have to do a big raise, the reason we would have a bigger minimum investment is because it would take maybe 500 or 600 investors if everybody's putting in $30,000, and that would just be very difficult to do. So anyway, the point is that will be situational, but probably $50,000 to $100,000. Target cash on cash. So I mentioned the pref before, and again, the pref is, hey, if you put $100,000 in, we want to guarantee you at least a minimum of $4,000 to $6,000 being paid annually. However, that's not to say that that's exactly what it's going to be over the life of the deal. And I'll give you a quick example. I'm just going to kind of write up here above it. But let's say that we do a deal and the first year it's a 4% is paid out. So you get your $4,000. Now let's say we're executing on our value add strategy and year 2, the property's making more money and we're able to pay you $6,500. So that's 6.5% effectively on your $100,000. Now let's say the third year we pay you $8,500. And the fourth year, we pay you $12,000, right? So I could go on, continue with that. Right now, if you averaged all that out, how much did you make per year on your 90-day distribution money? Well, maybe it was 8 to 10%, something like that, right? If it started on a lower end and it ended up at 12 plus. So that's kind of why we set a benchmark to a goal to pay out about 8 to 10% over the life of the deal. Now, you might be asking, what is the life of the deal? Well, some deals we might sell at year 4 or 5, year 3. Don't get me wrong. We buy a deal and the next year somebody wants to pay us a few $1 million more than we bought it for. We would definitely consider that, right? We have a fiduciary to our investors to try to get you guys amazing returns and to look at all serious offers. Now, that being said, because of the nature of multifamily, because it takes you first couple, 6 months, 2 years, whatever it may be, to really get in there and shake things up and remodel, these deals tend to be held for somewhere between 4 years, 6 years, 7 years. And so that's kind of why we have a minimum hold time of 5 to 7 here. That's typical. Now, the other thing I want to mention, going back to this 70-30 split is the target equity. So the target equity return or multiple on this deal is 2 to 3x. So if you invest $100,000 with us, when the deal is up at year 4, 5, 6, 7, whatever it is, we want to hand you guys back $200,000 to $300,000. That's in addition to the cash flow you made, in addition to the tax benefits that you got, and hopefully have you guys be super happy. So that's sort of our typical deal structure. Get with Kevin, watch our documents, check out our videos. Yeah. Oh, and you know what? As I was wrapping up the video, let me just plug one more thing because it's on the whiteboard: our fees. So this is one thing to kind of mention. So, like, what do we make as the sponsor, right? So look at it from our point of view, because we kind of went over your guys' point of view. So from our point of view, there's kind of 3 ways that we make money on the deal. Number 1, we get the 30% of the upside. Number 2, by the way, we invest into each one of our deals. So we're going to be part of this investor side as well. It might be 5% of it, it might be 10% of it, but we're going to take some of our money, just like you guys are, and we're going to invest side by side with you. So we're going to make our piece of that. And number 3 is fees. So the typical fee structure on a deal is 2-2-1. Now, we don't do that every time. We might do 2-2-0, but I'll kind of give you an idea of what these 3 categories are. So category number 1 is the acquisition. So a lot of sponsors charge a 2 to 3% acquisition fee. And that basically means for us to find a deal, put it in escrow, do all the due diligence, front the money and all that, and then successfully close the deal and bring everybody together in a syndication, we would charge 2% of that deal. So if we're buying